How can you do a quick 5 minute stock analysis if you had all the figures in front of you? Yeah, let's find out. Hi, folks. Welcome to the podcast, The Way I See It, which is just my views on money, the economy, personal finance, and how they intersect. Yeah, and what we can learn from it. So I want to talk about how to interpret like if you wanted to buy a stock and you had options, which one would you go for? Like how would you do like a back of the envelope stock analysis? Yeah. So I try to say, okay, let's say the investor wants to buy, let's say he has already agreed he wants to buy banking shares. How can you do a quick analysis? You have all the figures in front of you. How can you do a quick analysis without actually going to calculate the fundamentals? So I picked, from my view, the first thing I did was I said, okay, let's go for the highest capitalized Nigerian banks. So highest capitalized basically means I want to go top down. I'm trying to get the really big banks. And the capitalization simply means the number of shares those banks have multiplied by the market price. And then I ranked it in terms of in terms of their order. So the largest Nigerian bank by capitalization is going to be Guarantee Trust Bank. Yeah. And the second bank is going to be Zenith Bank by way of capitalization. So that's my first point. I'm looking at highly capped or big banks because I feel that in a COVID environment, a bank with a lot of capital will be able to withstand the effect of a loss of income. So that's the first classification, capitalization. Then what do I go to next? Well, the bank is there to make money and I want to get a share of the money they're making. So I'm looking at earnings, correct? I want to know how much the bank has made in terms of earnings. Because if the bank makes earnings, that tells me, okay, possibly I might get a share of those earnings. So I go to earnings. Like I said, I'm not calculating it. I already have the figures in terms of maybe the newspaper or the stockbroking sheets. I just want to pick out and do a back of the envelope analysis. So the next thing I go for is going to be the earnings per share. So the earnings per share for Guaranty Trust Bank is basically 6.55. So earnings per share is basically the earnings divided by the total issued share capital. So that figure gives me 6.55. That means every share of GTB is basically earning 6.55. Okay, so let me compare that with Zenith Bank. What does that give me? Zenith Bank is giving me about 6.92. So slightly, just a bit of a kobo difference there. So if I bought more shares of Guarantee Trust Bank, I would in turn earn more per share. I would earn 6.55, but for Zenith Bank, I would earn 6.92. So first of all, I've gone to capitalization. I've picked the largest banks and I've looked at their earnings, i.e. the earnings per share. So what else do I go with? Well, earnings are given. How do I get that earnings? I have to buy the share, correct? I have to buy that share to get a share of that earnings. So to buy the share, I have to then look at the market price. So the market price for GT is about 35. This is 35 naira for one share. The market share for Zenith Bank is 24.45. Now, keyword and prices. The prices in of itself is just what the market is selling the shares to you. The prices don't really tell you much if you just take them singly as prices. You've got to compare that price to earnings. So you basically take that price that you've given and you compare to the earnings. That's what you have, the price to earnings ratio. So what I'm doing now is I'm taking the market price, which is a 35, and I'm dividing it, or I'm doing a ratio to the earnings of the bank. So the price earnings of Guarantee Trust Bank is giving me, as at today, based off the earnings of GTB, about 5.40. So what that means is that when I pay my price of 35 naira, I am getting 5.4, or I am paying 5.4% off earnings, i.e., in quote, I'm overpaying 5 times the earnings by paying 35, right? If what's the PE ratio of Zenith Bank is about 3.54. So that means that if I pay for Zenith Bank at 24.45 naira, yeah, I am paying at that price 3 times the earnings of Zenith Bank. So now if you look at it, which price is cheaper? The cheaper price would be the PE ratio is lower, because when you buy at that PE, you're basically buying at a lower price, i.e., you're buying those earnings at a lower price. So we don't look at the price per se. we want to compare that price to the earnings. And then you do that by looking at the price to earnings ratio. So in which case, GT Bank seems to have a higher PE ratio than Zenith Bank. So again, we've done the first thing, we've done the capitalization, then we looked at the earnings, then we came back and looked at the price to buy into those earnings by looking at the market price and then comparing that market price to earnings. Then what's the fourth thing I want to do? I want to look at basically what they're going to pay me back in terms of dividend yield. Remember, earnings are just what the share price has earned, but I want to know what I'm going to get if I actually held those shares. Let's say I held those shares, what will I get back? And how I can know that is by looking at the dividend that the banks have paid and then compare that dividend as a percentage. So I can compare it with, say, bonds or other shares and then see if my money if I lost by the opportunity cost by simply putting my money in GT or Zenith Bank. So what's the dividend yield of GT Bank? And of course, dividend yield is going to be the dividend GT has paid divided by the price that GT is currently quoted at. The dividend yield for GT Bank is 8.0%. The dividend yield for Zenith Bank is 11.45%. So what I mean tells me that if I bought a share of GT Bank at 35, my yield, the dividends paid to me, earn me by percentage terms 8%. What about Zenith Bank? If I bought one share of Zenith Bank at 24, and the dividends paid to me would earn me back in percentage terms 11.45. So, I mean, how can you use that dividend yield? You want to compare it now to the dividend yield that you earn from, say, a risk-free investment. So you say, okay, if GT and Zenith Bank are risky, i.e., they are stocks that the price goes up and down, so they carry a higher risk. If this is the risk return, I want to compare it to the risk-free return, which in this case might be, say, a 365-day bond if I was holding it for that period. If I compare that with GT Bank, the 365 treasury bill right now is paying less than 1%. So you can say there's a lot of compensation if I bought stocks, because if I bought the stock of GT, my dividend yield would be about 8, which is much, much more than 1. And for Zenith Bank, my dividend yield will be about 11.45. So I beat the risk-free rates. But what's the problem? I still don't beat inflation. So again, even though I'm beating risk-free rates, I'm not beating inflation. So all this basically, you can go much, much deeper than I've done. You can look at the beta, you can look at the valuations, the EBITDA, you can look at the earnings per revenue, sales to books. You can do a lot more with ratios. But I just want to just keep it really simple, like a quick back of the envelope. You're in an elevator. You just want to look at boom, 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 boom. What can I to give me a picture of what I want to buy? That's what I've done. I've gone straight for capitalization, because I'm saying that in a COVID situation, the bigger banks or the bigger organizations have more reserves to take them through. Then I went straight to earnings to know what those big banks were earning, what those big banks earning, and I want to compare that earnings with other banks, not just with Zenith Bank, also with the smaller banks, and say, hey, even though these banks were big, were they earning as much as what the smaller banks were earning? That's also what I want to do. Then I want to then go and look at the prices of the stock, because I want to compare the market price and then compare that price to the earnings to tell me how much I'm paying for that. If I actually pay the market price, what does that translate to me in terms of am I overpaying or am I underpaying? I do that by looking at the PE ratio. Then finally, I go to my dividend yield, because I want to know the actual cash that comes to my pocket. What does that correspond to in terms of inflation, in terms of other opportunities in the market? If I'm able to do that, I can then get myself a true comparison with the risk-free rate and vis-a-vis inflation. So for me, it's looking at the cap, it's looking at the earnings, it's looking at the prices, looking at the PE, and finally looking at the dividend yield. That's my quick back of the envelope calculation. That's the way I do it. If you want to go deeper, sure you can. Remember, you must always compare with others. So if you're doing GT and Zenith, you want to compare with other banks, the smaller banks, and see if in that sector they are overperforming, underperforming. Also remember, past performance is not an indicator of future performance. Buying shares are very risky. You can lose all your money. you can make all your money back as well. So it's a very, very risky proposition. Always make sure you speak to your financial advisor before you invest. All right, guys, we'll leave it off for now. We'll see you guys next time. Do continue to follow, continue to tell your friends about the Way I See It podcast. Let's build something here, guys. We're also on Facebook, FinPlan Carlo Archer 1. That's at FinPlan Carlo Archer 1. Thank you so much, guys. I appreciate you all. Bye.